Hello everyone, and welcome. Today let's talk about what's really happening in the stock market. The stock market is a dynamic and ever-changing environment where fortunes can be made or lost in the blink of an eye. It's a place where strategy, timing, and sometimes a bit of luck come together to create opportunities for investors. Think of the market as a wild party. Everyone crowds around the hottest stocks, chasing momentum. It's a high-energy atmosphere where the excitement is palpable and the stakes are incredibly high. Investors are constantly on the lookout for the next big thing, hoping to ride the wave of success. It feels great when you're winning, but chasing what's hot is risky. The thrill of quick gains can be intoxicating, but it often leads to impulsive decisions. It's important to remember that what goes up can come down just as quickly. It's like driving by only looking in the rearview mirror, dangerous and short-sighted. You might miss the obstacles ahead and end up in a worse position than where you started. In the stock market, this means not just losing money, but also losing confidence and the ability to make sound decisions. Recently, Deutsche Bank noticed the party's mood is shifting. The exuberance that once fueled the market is giving way to caution. Investors are becoming more selective, and the focus is shifting from high-risk, high-reward stocks to more stable, long-term investments. The crowd is moving away from those flashy, high-flying stocks. The stocks that once seemed like sure bets are now being scrutinized more closely. Investors are looking for safer havens, and the market is reflecting this change in sentiment. Momentum chasing isn't just slowing, it's reversing. The trends that once drove the market are now being questioned, and the strategies that worked in the past are being reevaluated. This reversal is causing a lot of uncertainty and volatility. This signals a big change. What worked yesterday may not work tomorrow. The market is in a state of flux, and investors need to be more vigilant than ever. It's a time to reassess strategies and make sure that your investments are aligned with the new market realities. Understanding this shift is key to protecting your investments. By staying informed and being proactive, you can navigate these changes and make decisions that will help secure your financial future. We'll break down what Deutsche Bank is seeing, providing you with insights and analysis that can help you understand the current market trends, why high beta stocks are out of favor, and what this shift means for your investment strategy. High beta stocks, which are more volatile and risky, are losing their appeal as investors seek more stable options, and what this means for you. This shift in the market requires a reevaluation of your portfolio and a focus on long-term stability over short-term gains. We'll also look at where the money is moving now. Understanding these new trends can help you make informed decisions about where to allocate your resources. Most importantly, we'll talk about how you can make smarter decisions for your financial future. By staying informed and adapting to the changing market, you can protect your investments and achieve your financial goals. So grab your notepad and let's get started. There's a lot to cover, and the insights you'll gain can make a significant difference in your investment strategy. Let's get smart about your money. Together, we can navigate the complexities of the stock market and make decisions that will help you achieve financial success. Deutsche Bank's analysts have sounded the alarm. The chase for high-risk, fast-moving stocks has slammed into reverse. Imagine a crowd suddenly turning and running the other way. That's how sharp this shift is. The appetite for risky stocks is now even lower than before the recent frenzy. When big investors get nervous, they pull back from risk, and that's exactly what's happening. The gains from the recent run-up have vanished almost overnight. This is a classic sentiment shift, from optimism to caution. When institutional investors sell, prices drop, and if you're still holding on, you could get burned. Don't just follow the crowd, understand why it's moving. Deutsche Bank's warning is a clue. The game is changing and you need to adjust. Protect your future by staying alert to these shifts. High beta stocks. What are they? Beta measures how much a stock moves compared to the market. High beta stocks swing more wildly, up more when the market rises, down more when it falls. These are often tech companies or new, exciting businesses. In a bull market, high beta stocks can supercharge your gains. But the same volatility that brings big wins can also bring big losses. When the market turns, these stocks can drop twice as fast. Investors loved the thrill, until the risk became too real. Now, with uncertainty rising, they're jumping off the speedboat and back onto the steady ship. The shift away from high beta stocks is about seeking stability over speed. Don't ignore this change in psychology. It's a warning to rethink your own risk. Equity positioning shows how much money investors have in stocks versus safer assets. When positioning is high, investors are confident. When it's low, they're cautious. For the first time in months, overall equity positioning has dropped below its historical average. This means the market's mood has shifted from brave to defensive. Investors are holding less in stocks, bracing for trouble. It's not just a few nervous traders, it's a broad, market-wide move. More cash is sitting on the sidelines, waiting for clarity. While this can mean opportunity if good news comes, for now, the market is buckling up for a bumpy ride. Pay attention to these signals. They reveal the market's true mood. Don't get caught off guard by sudden shifts in sentiment. Use this information to review your own risk exposure. Stay prepared for what's next. There are two big players in the market: discretionary investors, the thinkers, and systematic investors, the computers. Thinkers use research and judgment. Computers follow algorithms and data. Both control massive amounts of money. Deutsche Bank found that both groups are now reducing their stock holdings. The thinkers are underweight, playing defense based on their outlook. The computers, once bullish, have flipped to cautious as their models react to new data. When both humans and machines pull back at the same time, it's a strong signal. The consensus: caution is in, risk is out. Watch what the smart money is doing. It often leads the way. Adjust your own strategy accordingly. Big investors are getting cautious, but money isn't leaving the market entirely. Instead, it's shifting, sometimes quietly, sometimes in big waves, from one place to another. The headlines might make it sound like everyone's running for the exits, but the reality is more nuanced. In fact, equity funds just saw a huge influx, over $26 billion in a single week. That's a sign that, even with uncertainty, there's still plenty of confidence in the market's long-term potential. Investors are looking for places to put their money to work, not just pulling it out. Everyday investors are still putting money to work, sticking to their long-term plans. They're not just reacting to headlines, they're thinking about their futures, their retirements, and their goals. This steady approach helps keep the market resilient, even when the news cycle is turbulent. Where's the money going? Mostly into U.S. stock funds, $13 billion last week alone. The U.S. market, with its size and stability, continues to attract both domestic and international investors. The U.S. is seen as a safe haven, even as investors avoid the riskiest stocks. People are being selective, favoring companies with strong balance sheets and reliable earnings over speculative bets. Another big chunk, over $9 billion, went to emerging markets, where growth potential is strong. These regions offer opportunities for higher returns, especially as their economies expand and new industries emerge. This isn't panic, it's rotation. Investors are moving their money from sectors that have run hot to those that might be undervalued or poised for growth. Money is moving from high-risk stocks to more stable or promising areas. It's a strategic shift, not a retreat. An effort to balance risk and reward as the market landscape changes. The story isn't fear, it's about seeking new opportunities. Investors are scanning the horizon for the next big thing, whether it's in technology, green energy, or global markets. Follow the flow to see where confidence remains. The movement of capital tells a story about where investors believe the future is brightest. Don't assume all market moves are the same. Look for the rotation. The details matter, and understanding them can help you make smarter decisions. Stay flexible and open to new trends. The market is always evolving, and those who adapt are best positioned to benefit. That's how you find the next opportunity, by watching where the money goes, staying curious, and being ready to act when the time is right. Everyone's obsessed with interest rates, but it's not just their level that matters, it's their stability. High rates hurt stocks, but wild swings in rates create even more uncertainty. When rates are unpredictable, businesses and investors freeze. History shows the market can handle high rates if they're steady. Once volatility calms, confidence returns and stocks can rally. It's the uncertainty, not just the rate, that paralyzes the market. Think of crossing a river. A steady current is manageable, a chaotic one is not. The market has been waiting for stability. As rate volatility subsides, investors may finally move forward. Watch for this shift. It could signal the next rally. History teaches us that markets struggle during rate hiking cycles. Volatility is high, and risk-taking dries up. But when central banks pause and rates stabilize, the storm passes. The seas aren't perfectly calm, but the chaos fades. That's when stocks often begin to rally, not because everything is perfect, but because the fear of the unknown is gone. Investors move from hiding in cash to seeking returns again. The end of uncertainty unleashes buying power. This could be happening now. Inflation is cooling, and the Fed may be done hiking. High but stable rates can be a positive backdrop for stocks. The rally isn't about perfection, it's about clarity. The calm after the storm is when smart investors set sail. Don't wait for perfect conditions. Look for stability. That's when opportunity returns. So, what should you do when the market feels uncertain or headlines seem overwhelming? First, don't panic. Remember, market ups and downs are a normal part of investing, not a sign to make hasty decisions. These shifts are about short-term strategies, not your long-term goals. The most successful investors know that staying the course is often the wisest move, even when things get bumpy. Stay focused on your financial plan. This is a marathon, not a sprint. Diversify your investments across different asset classes, industries, and even countries to help reduce risk and capture more opportunities. Don't put all your eggs in one basket, especially not in high-risk stocks. Spreading your investments helps protect you from the unexpected and smooths out the ride. Review your portfolio regularly. Ask yourself if it's balanced across sectors, regions, and company sizes. Adjust as needed to stay aligned with your goals and risk tolerance. Focus on quality. Look for companies with strong balance sheets, steady earnings, and a proven track record. These are the businesses that tend to weather storms and come out stronger. These are the steady ships that weather storms. Keep investing regularly, no matter what the headlines say. Consistency is your friend. Dollar cost averaging, investing a set amount at regular intervals, helps you buy more when prices dip and less when they rise, taking the guesswork out of timing the market. Don't try to time the market. Consistency wins over chasing trends. Even the experts can't predict every twist and turn. Stay informed, stay diversified, and stay disciplined. Make it a habit to review your plan and learn from reliable sources. The market will always shift, but your strategy should be built to last. Think of your plan as a sturdy foundation that supports your future, no matter what comes your way. Be smart, be patient, and take control of your financial future. With discipline and knowledge, you can navigate any market. Now, go own your financial journey. Every step you take brings you closer to your goals. The smartest investors are those who keep learning and adapting. Stay curious, keep growing, and remember, your financial future is in your hands.